Hello, hello. Good morning, everybody. Happy Monday to you all. Lots going on in the marketplace, so let's dive in with what we can expect for this week. What's going on with the bond market? Well, the Federal Reserve lowered the Fed funds rate last week, and in doing so, they lowered it 50 basis points instead of a 25. The bond market specifically, hasn't taken that very well, and it's not abnormal for the bond market not to take that and run with it. But I think what's happened is because there was a 50 basis point, it signaled that they were behind the eight ball and they know it, the Fed. And it also signaled that, hey, maybe now, because that half a point reduction affects what? Credit cards, car loans, HELOCs, things of that nature. All those things are somewhat inflationary, right? Because you're now going to go out and spend money on credit card, buy a new car, or take money out on your HELOC to do what? Spend it. So all those things are inflationary. I think the bond market's a little bit concerned. And as you can see, this is where the announcement was right here. We had a pretty big deep dive here. And then since then, we have not been able to close above this Fibonacci level, which is very interesting. Bonds are still overbought. So there might be some profit taking happening at this point, but we simply don't know. So what does that mean for rates? Well, nationally, last week we were at 6.12. We went up to 6.20 nationally this week. Again, these are for 20% down, 780 buyers in a conforming loan. Everything else is what it is per your credit scores, etc. But as you can clearly see, rates are a little bit higher as a result of it, which is not what you would have expected. But as I've always said, the Federal Reserve lowers short-term rates, mortgage bonds are long-term rates, and if we go back, and as you can see, since about the beginning of August, this whole thing has been cooked in. So the bond market was expecting this reduction. Were they expecting a half point? No, they got the half point, and I think that's why they're vacillating.
So if you find this stuff useful, do me a favor, like and subscribe our YouTube channel, and then jump on Instagram and go and find me under Omid S. We post daily updates on Instagram as well.
So what's happening this week? Really today, nothing. Anything in yellow, by the way, is not earth-shattering as far as market movement goes. So Case-Shiller Home Price Index, FHFA Home Price Index, those are coming out Tuesday. New home sales report comes out on Wednesday. Durable goods orders, so airplanes, things of that nature, that gives us a sense of the feeling of how healthy our economy is. And perhaps most importantly, the gross domestic product. This is the Q2 final read that comes out. Initial jobless claims, that's going to be the big thing that the Federal Reserve is going to be looking at in order to be able to see the health of the economy, is what kind of unemployment filings there have been for benefits. And then last but certainly not least, the Fed's favorite measure of the inflation, which is personal consumption expenditure. Man, there's so many words, isn't there? So the PCE is their favorite measure. And if you're asking me, I think the PCE, especially at the core, is going to look a little bit higher than what it is that they want. So it'll be interesting to see what's going on. Now, as we call our little buddy here, Captain Obvious. So Captain Obvious was on, and they asked him about what's going on with housing. So these are the bullet points of an hour's worth of rambling. So stay with me here. So Chairman Powell says housing market is difficult to predict due to its current condition. Well, thank you, Captain Obvious. Market is partly frozen because of low rate lock-ins. And by what he means by that is folks that bought their house 6, 8, 10 years ago or refinanced it, and now they got 2.5% 30-year fix, and they cannot move. They want to move, they cannot move. Homeowners with low mortgage interest rates are reluctant to sell. Yes, we knew that. The real issue is a lack of housing supply. He says that insufficient housing supply is expected to continue, to which I say this is a local issue. And if local governments really kind of start to dig in and change things, like how long it takes to get permits, et cetera, and be a little bit more friendly to our builders, we could see a movement in that, but I'm not holding my breath. So he then went on to say that the supply issue is not what the Fed can handle directly, which he is right. Went on to say that normalizing interest rates and controlling inflation will help stabilize the housing market. That's correct and true. But then supply concerns must be addressed by markets and local governments, and not just through monetary policy. So really, what does this mean for us at the end of the day? Well, what we see is what we're going to get for the next little while. If the bond market calms itself down, which I know that it will, we should be able to hopefully take advantage of some of the weakness we're seeing out in the labor markets to reduce interest rates as far as mortgages goes. And hopefully that will spur some additional home buying and or refinancing and or remodeling and things of that nature, so we can keep this economy kind of pumping. Okay. As always, just a phone call away if you need anything. Otherwise, have a fantastic week, and we'll catch up with you again soon. Follow me on Instagram because that's where all of our little stories are posted on a daily basis, so you're in the know and see exactly what happens as soon as it happens. Okay? Cheers.